Sell in May and go away. Alright guys, you've heard it. In this video we'll be exploring this investment maxim, or strategy if you may. This is one of the best known investment maxims out there, and right now it's just so topical. For those of you that don't know, we literally just had one of the best months ever in the history of the stock market. The S&P 500 gained 12.7% in April alone. Meanwhile, the Dow gained 11.1%. That's just ridiculous. And these are just indices. So you can imagine the returns on some of the individual stocks if you had bought them at the end of March. For Apple, that was 15.3. Pinterest, 33.8. And for Tesla, almost 50%. And just look at that. I mean, that's the third best month ever. The best month since January 1987. So why are a lot of analysts now saying maybe it's time to sell? So this maxim is actually known to be one of the calendar or seasonality effects. Basically, this tells us that you're better off to sell stocks at the start of May, that is the summer months in the Northern Hemisphere, and to not buy them until the start of November and hold them through till April. Some say during the summer months, there is a lack of market participants as people may go on vacation, making the market less liquid and slightly riskier. But now this year, there is the additional risk of the whole global situation to think about. So you can't really look at it in complete isolation. But analysts and investors are always looking for patterns in the stock market and forever betting on whether each year will be different or the same to the one before. And the truth is no one knows for sure what is going to happen. But most often than not, every year there are news articles about all these reasons why you should sell in May. And it just happened to be this year that the strategy is gaining so much more attention, and especially on the back of the third best month we've ever had. But let's look at what the data shows. For example, a strategist from Morgan Stanley recently showed that the November-April period has a higher average return than the May-October period using S&P 500 data from January 1928 to March this year. And that's 5.1% compared to 2.1%. And that the November-April period has a higher probability of producing positive returns than the May-October period. So basically, the 6 months from November to April, on average, beats May to October in all categories mentioned here. Another firm, LPL Research, also listed out the May-October returns for each year for the last 10 years. And as you can see, there's still more positive returns than negative returns. So does this mean holding through the May-October period doesn't seem so bad after all? But bear in mind that sell in May doesn't necessarily mean negative returns. But now let's compare that with the November-April period. So I've calculated the S&P 500 returns for the November-April period for each of the last 10 years. This spans from November that year to April in the following year. As we can see, for the last 10 years, the average is definitely higher for the November-April period. That's 6.6% compared to 2.6%. For some specific periods though, we can see that the returns do vary quite a bit, but overall, the November-April period does come out on top. The strategy is also famously known as the best 6-month strategy, first mentioned in the Stock Trader's Almanac by Yale Hirsch in 1986, and is now run by his son, Jeffrey Hirsch. The strategy focuses on investing in equities from November to April and then switching to fixed income securities for the other 6 months. Through their research, they found that this strategy produced astonishing returns. Using this strategy, you would have a gain of around 2.8 million as of the end of 2017. But wait, there's a catch to this. The strategy they used is a bit more complicated as it uses moving average triggers to determine buy and sell signals. So this 6-month period is slightly more fluid, meaning the period could start a few weeks earlier or later than November, and can also end earlier than the start of May due to these signals. But even if you were to simply just follow the original strategy, then you'd still have a gain of around $1 million. On the other hand, if you only invested from May to October for the same period, you would actually make a loss of $5,862 on your $10,000 investment. One thing though you guys should be aware of is that there's a typo in some of these news articles that talk about the strategy, and it's the fact that these articles mistakenly mention the S&P 500 instead of the Dow Jones. So if you look back to the 2019 version of the Almanac by Jeffrey Hirsch, you'll see that the strategy is based on the Dow, but on his website he does give the full set of data for the 3 biggest US indices. And you'll see that the 2.8 million is actually from investing in the Dow. And the links are posted in the description below if you wish to have a look yourself. So we've talked a lot about the idea of the strategy, etc. But what is the practicality of this? So basically, the strategy means you're only going to be invested in the stock market during 6 months of the year. So effectively, you're going to be giving up the opportunity of earning a return from May to October if this period turns out to be positive. And not only that, you're going to be giving up the dividends you would have received and reinvested had you not sold these stocks during the period. Interestingly, on Hirsch's website, we can see that the buy and hold strategy on the Dow from 1950 till 2017 actually produces a higher gain than this 6-month strategy without the trade signals. That's 1.2 million compared to 1 million, exceeding by around $200,000. So this suggests that you would actually be better off if you had bought and held the Dow during this period than if you tried to time the market. And you have to know, this 68 period isn't exactly a smooth ride. So the big question is, what should you do if you're invested in the stock market right now? Unfortunately, there is no definite answer, but here are a couple of things that I think are worthy of considering. So the first one is adjusting your portfolio composition. If you're worried about weaker returns during May to October, but also don't want to miss out on the returns if it actually turns out to be more favorable than expected, then you could consider pulling out of the riskier stocks and take a more defensive approach. For example, index funds, and then subsequently adjust back at the start of the other 6 months. The second one is raising cash. There is nothing wrong with raising a bit of cash when you do feel like the economy outlook is murky, too many uncertainties, and you feel that it is probably sensible to reduce your exposure to the stock market, and you wish to deploy this cash when the stock market isn't as overpriced, finding a better entry point. Likewise, you may also use it to average down on your other stocks. Of course, all this depends on your investment objectives, your personal circumstances, how comfortable you feel, whether or not you can sleep properly at night, even when the stock market doesn't go your way. But definitely don't force yourself to take risks that you can't handle. So stay safe out there, guys. Thanks for watching, and let me know in the comments below of what you think about the stock market right now, and I'll see you next time.